Hey everybody, and welcome to this course on technical analysis. I'm going to be going over the absolute basics. So if you're someone who's never traded or you're a beginner and you're looking for some place to start, this is it. So let's take a look at some charts. Here we have some lines going up and down. There's some lines going on at the bottom. This person who's made this chart has highlighted a bunch of stuff. You see rising wedge. It's kind of hard to see. They say there's an arrow going down at the end, and it's difficult to see what's going on. In this next one, there's a lot more lines. There's a lot more indicators down at the bottom. There's a whole heck of a lot of information contained in this one chart. And in this third one, I don't even know what's going on here. Who knows what this person is trying to do or what they're trying to say or where they're getting all of this information from. But in all three of these cases, no matter how convoluted and confusing they are, what they're using is called technical analysis. And some people might think that technical analysis is a bit like looking into a crystal ball, or it's a bit like reading the tea leaves. But I would say that the results should speak for themselves. So the goals of what you can do with technical analysis, and first of all, it's going to allow you to find good high probability trade setups. You can look for momentum plays, you can try to fade, looking for rebounds. So there's different strategies that you can use to try to find the trades that you want, depending on the type of trading that you're doing. Second, technical analysis is going to give you a better understanding of where to enter a trade. So what's the best point to get into a trade? And third, it'll give you a exact place of how much profit you should take in the trade. So it'll tell you when to get in and when to get out. And those are two of the biggest things that you can use technical analysis for. Lastly, it's going to keep you from losing money because it'll help you set stops, which a stop is where you set the absolute limit of how much money you want to lose. And using technical analysis, you can find that and determine your stops down to the penny. So there's going to be 3 course sections in this course. The first is going to be a general overview of technical analysis. This is more of kind of a philosophical discussion, kind of describing the benefits of technical analysis, what it can do, what it's used for, and what are some of the limitations. In the second part, I'm going to go over charting. So I'm going to start with just pretty much a blank chart, go through the different types of charts, start adding in indicators, looking for patterns, and just go through it all. So at the end, you'll be able to use a chart yourself and be able to look at it, be able to use the indicators, and also find patterns and trends so you can use for your actual trading. And lastly, later on, much later on, we'll get into some strategies that you can use with using the basic things that I'm going to teach you, like trend lines and squeeze plays and looking for momentum. So all of these are what we're going to cover in this course. Okay, so let's go over some assumptions required for technical analysis. First is that price discounts everything. And all that means is that everybody that's participating in the market has all the information available about a certain a certain company, a certain stock, bonds, whatever the tradable asset is. All the traders as a whole contain the full amount of knowledge that there is to know about this company. So what that means is that the current price of where any kind of security is going to be the sum of all that knowledge. If there was knowledge that someone held secret, then they could use that to profit from it. But eventually somebody else would find out and that knowledge would disseminate, and then the price would return to equilibrium. Second, price movement is not always random. And what this means is that the markets are psychological, and that the people that trade on them follow psychological rules. And They have certain things that they will do and have certain things that they won't do. So what this means is that price will follow in trends. It doesn't just go up or down randomly. It means that if people think that a company is going to grow and it's going to get bigger and it's going to be worth more in the future, then the price will go up because people will be buying the stock or whatever security is with the belief that the price is going to go up in the future. If they believe that the price is going to go down in the future, then they would want to sell it, because if they sell it now and it becomes cheaper to buy or sell back or buy back, then it'd be better to sell now. So the market is always driven by psychology of people's beliefs, and we can use that in technical analysis to determine trends. And lastly, technical analysis is more about the what than the why. So for technical analysis, price history matters. What has the chart shown? What has it done in the past? What was the psychology of the market participants in the past, which led to the price of the security being what it is now? So it's more interested in what happened instead of what will happen. So let's talk about the limitations of technical analysis. It can only provide short to medium term analysis. You're not going to use this to find out what the price of gold is going to be in a year or 2 years or 10 years. You're going to be more focused on smaller time frames that will allow you to confirm your beliefs in the trend. Second, people's views on a security can change rapidly. So even though you may have a belief with your technical analysis, certain news can come out, or people can change overnight on their ideas. And it could be about the smallest things as well too. So the thing about technical analysis is you always have to be able to revise your own beliefs and your own opinions about the analysis that you're doing. You can't just be fixed into one belief that something's going to happen and then not take into account the up-to-date events which are directly affecting the price of the security. Third, technical analysis is not the best around binary events. So especially around earnings, it's not good to use technical analysis because you don't know what the company's going to post. You don't know what the Fed is going to come out with and say. So all these things where there's a lot of volatility leading up to an event is not the best for technical analysis. So one thing that we do is, right around the time of the Fed announcements, it's always good to trade, to have most of your positions closed, especially if you're trading Forex or anything else that would be directly affected by the Fed. And then immediately after the Fed announcement, then you would enter into trades depending on the news that came out of it. Fourth, your biases affect how you interpret your chart. So two people could look at the same chart and come to two different understandings. So always remember that in a market where if you're buying, somebody else has to be selling. So if you're buying a stock thinking it's a good value, someone may be selling a stock because they think it's overvalued and they want to get out. So always remember that just because you believe something and everything looks to be a certain way, it may be the opposite, or it may just not be the case at all. So different securities require different technical analysis interpretations. So an indicator that we commonly use, maybe MACD or stochastics, may work well for one security, but it won't for another. So if you're using trend lines for gold, that may not work for something else, for like bonds or for certain types of stock which are quite volatile. So you have to be able to adjust your type of analysis depending on which type of security you're trading. So again, the benefits of using technical analysis: it provides specific entry and exit points. It gives you a warning when a position should be closed if it's going into the red and it becomes a losing trade. And third, it's going to confirm trading trends as well too. So it'll tell you if a stock is building momentum upwards, if it's falling. So you can determine trends if it's trading in a channel. There's many different ways that you can use. And fourth, it allows for the development of a broad portfolio, because usually when you're doing technical analysis, you're starting from a top-down view of the market. So you'll start every day looking at the S&P 500, and you'll see, well, what's the S&P doing? What's the NASDAQ doing? What's the Dow Industrial doing? When you determine that, then you can go in and you can go down to the different sectors, what's going on in banking, what's going on in energy or transport. And when you have an idea about that, then you can go further down into the different stocks which make up those different sectors and look for any variations from the mean or for ones that are outperforming. So those are the benefits of technical analysis, and we'll get into that more later on once we start doing our charting. So with that, that's kind of the general overview of what technical analysis is. Next, I want to get into a chart and what is a chart and really the basics of a chart. So if I've said a lot now, which you don't understand, don't worry about it. We're going to start at the absolute beginning for charts, and I'm going to make it really easy for you to understand, and it's going to be a very good step-by-step guide, so you can go from knowing nothing about charts to being able to understand and use them for your own advantage. So let's go on in the next video.